Hey everybody, welcome back to Investing with Wesley. In today's episode, I want to keep explaining to you the very important topic of the different kind of rates that are out there. Today's episode is all going to be about the federal funds rate. Let's get into it. Now, the federal funds rate is the rate that all the media talks about when they say like, oh, the Fed's just lowered the rates to 0%. But what exactly is the federal funds rate and how does it affect you? Well, the federal funds rate is the rate that banks lend their excess reserves to other banks overnight. So by law, commercial banks are supposed to keep a reserve amount equal to a certain percent of its deposits at the Federal Reserve. So as an example, if on average all of the bank's customers deposited about $1,000 a week into this bank, then a certain percentage of that $1,000 would have to be stored at the Federal Reserve. And any amount in excess of that certain percentage held at the Federal Reserve can be lent to other banks that don't have enough in reserves. And when one bank lends to another, they charge the other the federal funds rate. Now, about 8 times a year will the FOMC meet. The FOMC is the Federal Open Market Committee, and their job is basically to decide whether or not the federal funds rate should go up, down, or remain the same. And they take in economic factors like inflation, possible recessions, as well as durable good orders. Now, it's important to know that the FOMC can't force banks to charge the federal funds rate. It is only a guideline and a recommendation, and the real rate is negotiated between the two banks. Now, oftentimes it is the federal funds rate or extremely close to it, and the actual rate that banks charge to each other, and not the guideline federal fund rate, the actual rate that the banks agree to lend money to each other is known as the effective federal funds rate. Now, typically due to the very short time horizon on all this lending of excess reserves, the effective federal funds rate is often very closely related to the United States repo rate. And obviously, volatility in the repo market will mean volatility in the federal funds rate. Now, if you're wondering what the repo market is, I'll go into more detail in a later episode, but basically the repo market doesn't stand for like repossession as far as like someone not paying their loans and that kind of stuff. When I say repo market, I'm actually talking about the treasury repurchasing market. And basically how the repo market works are extremely short-term deals, usually a day to 3 days, but definitely no more than 30 days. And basically what happens in the repo market is that banks will make a deal with financial institutions and hedge funds where the banks trade money for treasury bonds or treasury bills as collateral. That way the hedge funds and the financial institutions can use that money to make some sort of deal in an extremely short amount of time. And let's say after 3 days, the hedge funds or financial institutions will give that money plus a little bit of interest back to the bank. And the bank will give the treasury bills or the treasury bonds back to the hedge funds or financial institutions. It's basically a really quick trade. So financial institutions and hedge funds have a little bit more capital to invest and capitalize on really good deals happening right this second. And that, in short, is the repo market. So when the interest rate that banks charge to these financial institutions, when that repo rate experiences volatility, it can bleed over into the federal funds rate because, like I said, the effective federal funds rate is very closely tied to the repo market. And I know right now you're probably thinking, who cares and why does that matter? But trust me, stick with me, because in the next episodes when I start talking to you about the SOFR rate, I connect all these dots together and you could really see exactly how the economic machine works when it comes to these rates and why they're so important to you. But for now, let's get back to the federal funds rate. Now, the reason people make such a big deal about the federal funds rate is that it is literally one of the most important rates that the US has. Now, although it doesn't directly affect you and the interest you pay on loans like cars, credit cards, and that kind of thing, it does passively influence those kinds of loans. But mostly, the federal funds rate affects monetary and financial conditions, which plays a giant role in influencing the broader economy. And when I say the broader economy, I mean things like employment, economic growth, inflation, you name it. Everything that makes up the United States economy, the federal funds rate directly affects. And if you remember from my episode about the prime rate is influenced by the federal funds rate. And if you remember, the prime rate is the rate that you need to pay attention to when you're thinking about auto loans and that kind of thing, because the prime rate is most often used in those kinds of loans for consumers. So because the prime rate is affected by the federal funds rate, The federal funds rate is only that much more important for you to pay attention on, because as the federal funds rate goes up and down, so will prime and so will the interest that you pay. So even analysts and other investors pay attention closely to the federal funds rate, because typically the market will move in an inverse direction of wherever the federal funds rate moves. So as the federal funds rate goes down, the market will go up. And likewise, the opposite is true. If federal funds rate goes up and borrowing money becomes more expensive, typically the market will suffer for it because money is not as cheap to borrow, meaning the constant borrowing of money that goes on behind the scenes to continuously grow and expand isn't as easy or as cheap. So analysts and investors often pay attention to the federal funds rate so they can try to predict at which direction the stock market will go. But as me and you both know, it is impossible to accurately predict the stock market consistently long term. So although there is a bunch of probabilities and tools and statistics that analysts use, they can all still be wrong because no one can predict the future. And I only say this because I don't want you to start paying attention to the federal funds rate and then make wild assumptions about the market only to get burned. And make sure that whatever you want to invest in, you do the proper research. Don't invest because it's hype, and don't invest because an analyst told you it was going to be a win. But remember, the federal funds rate is extremely important. How it affects you is most often going to be indirectly. I doubt you're a giant bank watching this channel. You're probably a person. So you're mostly affected by the prime rate. But like I mentioned before, the prime rate is influenced by the federal funds rate. And if you have to, rewind this video to where I talked about the repo market, because like I said, it is an extremely important piece of our next video. But until that video airs, I hope you got value from this video, and I really hope I helped educate you on what the federal funds rate is and how it affects you. If you did get value from this video, please remember to like and subscribe, because it really helps the YouTube algorithm in getting this channel out there so I can help educate more people. Until our next episode, have a good one.